My name is Oliver Cann. I'm Head of Strategic Communications here at the World Economic Forum. Welcome to the first issue briefing of Day 2, the annual meeting of the New Champions 2019. Yesterday we had very much a technological feel to our issue briefings down here in the briefing centre. We talked about trust in AI, we talked about the power of platforms and whether they'd peaked or not, and we talked about the risk to jobs and the need for reskilling in the fourth industrial revolution. So we're going back to our business roots today with this session on shadow banking. The session is called Shadow Banking Today. We're trying to explore in this brief 30-minute session a little bit more of the terrain around China's informal banking sector. It's played an important role in helping the economy's transition towards a consumption-led model. Structural reforms have been aimed at de-risking the system and increasing private sector access to capital. But what role will the sector play going forward? And are we going to get the balance right between minimizing and managing risk and encouraging growth? That's what we're here to find out. These sessions are short and we try to keep them as high energy and as interactive as possible. So please feel free to stick up your hand, ask questions in Chinese or English, no other languages please, whenever you want. And we'll keep this conversation as dynamic as possible. I'm very, very much delighted to be joined by Huang Yiping, the Deputy Dean, National School of Development, Peking University, based here in the People's Republic of China, of course. So we're going to start with a couple of questions, but that really is just to bring us up to speed. And then I want you to take over and ask as many questions as you want. So Yiping, let's start very much at the beginning. Sure. We've had 2 years of reforms, and where are we at now in terms of getting that balance right between managing the risk of off-balance sheet finance and also encouraging growth and keeping the wheels and the machine oiled and running smoothly?
Well, just a couple of points to start with. We do have a relatively large shadow banking sector. If you look at the end of 2018 number, estimates vary, but some numbers point to something like 50 to 60 trillion yuan, the size of the total sector, which is roughly about 40 to 45% of the total outstanding loans in the banking sector. So that's the relative size of the shadow banking sector. The first point I think we need to note is when we think about the shadow banking in China, it's somewhat different from what you see in many other countries. In most other countries, when we talk about shadow banking transactions, they are mainly done by non-banking financial institutions. In China, it's mainly done by banks. That's why some people call it shadow banking. Is also, it's called a shadow of the banks. Activity is mainly done by banks themselves. And most common popular products are things like trust loans and wealth management products and so on. So the government realized that there might be an issue, the risk with the shadow banking about 2 years ago, as you mentioned. Then they start trying to regulate this sector, which I think is the right thing to do because the financial transactions all need to be fully covered by regulation, and the thing they're doing, I think, exactly right. However, we need to realize the motivations of the shadow banking transactions. The question is, why suddenly this surged? Usually when we think about the reasons why shadow banking transactions emerge, because people want to avoid bypass the regulation. So for instance, why banks want to move the transactions off the balance sheet? Because they want to avoid, for instance, the regulatory requirement for capital adequacy ratio and for reserve requirement ratio. These could be costly in a way for doing transactions. So once you move off the balance sheet, you avoid these costs. That is a potential benefit, but obviously the potential cost coming with it is the potential risk because they're not properly regulated. There is probably even more important reason why it's growing so rapidly in China is because the institutions also want to bypass some of the policy restrictions. So the reason why, for instance, they want to do off-balance sheet is that you can set the interest rate much more flexibly. On balance sheet, even though theoretically we no longer regulate the lending and the deposit rate, but these rates are not significantly flexible. So once you move off the balance sheet, then you become much more flexible. You look at the policy implementation so far, my sense is it's much more successful in bringing everything under the regulatory framework. So that's been happening. A byproduct, obviously, we actually saw reduction of some of these transactions, and that's why some of the activities, the private sector felt squeezed last year. But at the same time, I think it's still an ongoing process. What exactly will happen in this sector, we're still not very clear. For instance, on the one hand, now the banks all set up their own subsidiaries for wealth management products and so on. These will be slightly separated from the bank's own activities. But second, I think what also the question we needed to answer, as I hinted earlier on, once the regulators start to squeeze on the shadow banking transactions, the private sector or the SMEs felt disproportionately squeezed. So there must be an open question here. If they could serve some of the SMEs in the shadow banking transactions, what is going to happen when we bring these activities back to the balance sheet? That's something still needs to be addressed.
So we've talked about possibly a midway point, perhaps not midway, but we're on a journey, put it that way.
Yes.
Started 2 years ago, towards bringing the sector into more formal regulation.
Right.
At the same time, we saw, if the reports I read are correct in the English language press, we saw a decline in 2018 for the first time.
Yeah.
Arguably a successful move, or at least on target. And we've seen the growth in the economy relatively resilient and buoyant.
Right.
And yet there's a lingering commentary, again, I'm mainly focusing on the media that I read, that the private sector feels slightly frustrated.
True.
It doesn't have access to the same kind of funds.
True.
So it suggests that the balance isn't quite right there yet.
Right. Well, if you look at, I don't have the full-year data. If you look at the first half-year data last year, the shadow banking transactions was down by 2 trillion yuan. And that portion certainly, which means the funding was reduced. The banking sector tried to offset that decline by increasing additional 1 trillion yuan. So net, there was a decline of 1 trillion yuan funding for the real economy. The problem is structural. When you reduce the funding in shadow banking transactions, it disproportionately hit the private sector. When the banks trying to increase more credit to the real economy, and I guess by definition at the time was most of these credits still went to the large companies and some of the SOEs. So the increase and the decline did not really exactly to the same potential customer groups. That is why the private sector was hit hard, certainly last year. And I think one of the key reasons why the formal banking sector find it very difficult to deal with the SMEs is because when they look at the credit risk, normally they look for 3 things. Number one, they look at historical data. Number two, they look at the fixed assets, which can be served as collaterals. And number 3, if there's implicit government guarantees. Now, the private sector and SMEs in general, they don't have any of these. That's why the banks sometimes they don't know how to deal with them. While some of the off-balance sheet activities, they become more flexible, they rely on so-called the soft information the offline and the big data analysis online and looking at the assessment of the risks. They could actually do a better job. Number 2, about the interest rate setting. As I said, the risk pricing is basically about higher cost of capital for riskier customers. So if we're dealing with the SMEs, which by definition are with higher risks, by definition you should charge higher lending rates. But on balance sheet activities, the formal loans, there is a limit on how much the interest rate you can raise. That makes it impossible for the banks to serve these customers. So this is a much bigger issue than just the shadow banking itself. I think we need to push ahead with interest rate liberalization much more aggressively in order for the banks to better serve these SMEs.
And we're moving to a whole new territory here, which is the lifeblood of the economy. 60% of GDP, I understand. 90% of all new job creation.
True.
Isn't it? So it's an incredibly important sector. We'll come to that, but it's a good juncture to see how many questions we can get answered. I'm sure there's going to be a lot of people with hands up, so we'll try to move through as many as possible. So David, let's have the microphone to the gentleman here in the front row, the lady in the second row here. We'll do three, and then we'll group them up and see if we can.
Sure.
Hi, Professor Huang. I'm Yuan Ding. I'm the Dean of China-Europe International Business School. Among the shadow banking demand, there's another important element, which is the financing platform for local governments. You talk about implicit guarantee, and we also want to crack down this kind of implicit guarantee. So what is your view on this important point? Thank you very much.
Great question. So local government as well, not to be forgotten. Lady in the, that's right, you, ma'am. And would you mind giving us your name as well and tell us where you're from, please?
Thank you. I'm with China-based journal. I'm wondering what's the standard for the adequate or moderate shadow banking? Could you give a specific and detailed description of standard? Thank you.
Not sure if I understand your question. What are the standards for what?
就是影子银行，就是说现在有一个
When you talk about shadow banking, there should be appropriate space for shadow banking to develop. Do we have a criteria to describe that? Thank you.
So criteria for shadow banking. And a gentleman there in the middle of the second row, please.
Carl from Indonesia. In Indonesia, we have a long problem in the financial deepening and the capital market penetration, considering that our bank penetration is very low. And then now we are witnessing that the fintech actually can contribute significantly and start moving the needles. But the problem now, this is what our government said, now they are looking to the how the Chinese government start regulating the fintech. So could you please explain, I think you haven't touched the relation between fintech and shadow banking and how the Chinese government, start regulating the sector. Thank you.
Okay.
This is a good sweep, isn't it? So we have local government, we have what do standards look like, and then we've got the role of disruptors such as the financial technology sector.
Right.
Can we start with local government?
Sure. Well, the local government borrowing is, first of all, a main fiscal phenomenon. I think the reason why local governments are all actively borrowing money, it started earlier, but really became a main phenomenon after 2008 in the process of the global financial crisis. As a part of the big stimulus policy, local government also all start to borrow money. I do think that on the one hand supported the growth, but created lots of negative impact on economic activities. So first, for instance, it really crowded out a lot of private sector investment. And as you said, the guarantee, the pay, was not really helpful for the development of the financial market. One thing we found quite interesting, the government many years ago decided that we needed to push ahead with development of the capital markets because we want to raise the proportion of direct finance in total finance. And the hope was, well, maybe some of our depositors will take a little bit of money out of the banking sector and invest in the capital markets, the stock market and the debt market. Unfortunately, what follows later on, you realize is some people actually took out some money from the banking sector, but didn't go to the formal capital markets, went into the shadow banking sector. And I think a part of the reason why they went to the shadow banking transaction was they need good places for decent returns for investment. And part of the story is the guarantee, the payment. So I think while the local government borrowing on the one hand provide these opportunities for investment, to some extent they actually is not very good for market discipline. Households all want to make investment in these products, and in the end it becomes a big problem. If the local government platforms could not pay, the banks have to, most of the banks will have to pay. And that actually causes further problems in enforcing market discipline going forward. So I actually think that is a very negative development in terms of financial development. The problem, I think, what the government is trying to do now is trying to stop them from directly borrowing from these financial markets. However, they did not come up with additional source of funding for these activities. So what we are finding at the moment is the local governments are just struggling. On the one hand, the central government said, well, you shouldn't continue to borrow from the market. And the central government is also cutting down tax rate. But at the same time, the local governments still have all these responsibilities. So I don't know if we have a clear solution yet at the moment. But that's something we need to be designed to design a top-down a plan for reform of this the whole issue. The question about what is appropriate degree or criteria for development of the shadow banking, I wouldn't want to list the detailed specific criteria for development. I think it is more important is whether it's shadow banking or it's off balance sheet or it's on balance sheet. What is most important is we should integrate these two parts and unify the same standards. As I said earlier on, I do believe that all financial transactions need to be covered by financial regulations. So anything that bypasses the financial regulation, we should change that situation. But most importantly, at the moment, I think what we should do is, if we want to push the off-balance sheet transactions back to the balance sheet, the first thing we needed to do is we needed to support the banks to comply with these regulatory requirements. And one particular challenge now is many banks are not able to bring back these transactions because they don't have enough capital to support these activities. That issue needs to be changed. The second issue is, as I said, interest rate liberalization. If you're able to lend off balance sheet at higher rates to riskier customers, that actually is good for the economy. But once you push back to the on-balance sheet, if you have to follow the same interest rate regulation, then literally you have to stop these funding activities. So I think all these changes need to be unified. Whether you're off-balance sheet, you're on-balance sheet, we should follow the same set of rules. That's my suggestion. Finally, the fintech question. Fintech is becoming very big. Now, my own sense is the reason why the fintech is growing so rapidly in China, there are many reasons, but one particular reason is because of the repressive financial policies in the formal sector, which means we do have a very large financial sector, but a lot of potential customers are not adequately serviced. So the SMEs and the low-income households, they did not receive sufficient financial services. That's why the fintech, whether it's a digital payment or online lending, when they start to grow, they were enthusiastically embraced by the market. And that, I think, was a good reason. In fact, in other words, they filled the existing gap in the market, and that was a good thing. But at the same time, we also saw some problems that these, I mean, you could, in a way, you could think these fintech activities also as a kind of the shadow banking transactions. They're not fully regulated by the regulations, and they're more flexible in terms of interest rate setting. So on the one hand, it's actually a good thing. But on the other hand, they're not properly regulated, and we are seeing a lot of risks. And the peer-to-peer lending is one example, and the anchor just mentioned earlier. That is probably one area with most significant risks, and the regulators want to consolidate it. At one point, we had 6,000 platforms. I think, according to the new regulation, probably only a very small number of the platforms can survive. But at the same time, we also see these new online lending activities growing. More proper the lending activities, they actually become a new form of banks. For instance, Tencent has a new bank called WeBank. Ant Financial has a new bank called MyBank, and there's another bank in Chengdu called Xinwang Bank. All these online banks, they're helping the SMEs in a very, very significant way. And because they don't, I mean, the Ant Financial, MyBank has an interesting so-called 310 model of making loans. A potential customer only needs to take 3 minutes to fill the application form online for 3 minutes. Within 1 second, the money is into your account. There's no human interference. That, in a way, solves the problem I mentioned earlier. The banks did not know how to deal with the SMEs without historical data, without fixed assets. And this new form of financial activities, they actually found a way, and the way was mainly relying on big data analysis.
So we have 6,000 platforms,
Yeah.
you estimate, a wealth of new entrants to the market to disrupt the traditional sector.
True.
We probably don't know how much debt is out there. How much of a bad debt problem is shadow banking?
Well,
or a potential bad debt problem?
I don't know the total number. This is 6,000 platforms is a big number. But it also involves lots of people because all amount were relatively small. But the overall size of the market was still relatively small. I think at some point, I mean, the highest number was probably the total outstanding loan in that sector was a bit over 2 trillion yuan. That compared to like 50, 60 trillion yuan in the total shadow banking sector and 136 or 140 trillion yuan in the formal banking sector is tiny, but it affects lots of people. There was one platform which collapsed at the end of 2015 called Yizhubao. It's not a big amount of money, but it involved almost 1 million investors. So in a way, social stability was a bigger concern than financial stability in these cases.
And the overall health of the Chinese economy, just to be clear, is not at risk from this sector?
I don't think that is a bigger problem. There are issues we need to deal with. In the shadow banking transaction at the moment, it's not so much about how much investment becomes bad. Potentially, there will be some non-performing loans. The problem is the so-called the guaranteed payment, not just by the local government platforms, but also when the banks, for instance, issue wealth management products, one way or the other, explicitly or implicitly, they would say, well, these are safe investment. And then if the investment become a problem, it actually become a burden for the banks. So you move off the balance sheet, but the burden is still with the banks. That potentially could be a problem. But my guesstimate at the moment is it's not yet a systemic risk for the banking sector. The issue is serious and needs to be dealt with, but I don't think it will affect the banking sector stability in the perceivable future.
I'm sure, we're rapidly running out of time, so I'm sure we've got lots more questions. Let's have a quick show of hands. We'll do another round. Okay, lady, you were first. Lady in the back row, gentleman there, and let's try to do 4 this time, shall we? So we'll do, Mum. And please remind us where you're from and your name as well.
Thank you. I'm West China Daily. My question is about the interest rate liberalization. Mr. Huang, you said before that the interest rate liberalization will change the situation of the borrowing costs for SMEs. But there is a conflict. If we free the interest rate, then because of the higher risk, so their borrowing cost will be higher. So how can we solve this problem? And also, if we introduce the LPR for the next step, what will be the big changes for banks to set up the lending costs?
Okay, and gentleman there in the back row, please.
Professor Huang. Thank you. I'm Gao Feng from Deutsche Bank. You mentioned about market discipline, and also you alluded to the implicit guarantee. The common sense, if you let the market work, meaning if allow default to happen, then the information will get cascade down and sort of solving the problem. You don't really need to have additional design. The problem there then is the social instability that you were talking about. So what do you think is the government's tolerance level on social instability?
Okay, that's great. So we're moving from systemic financial market risk to social stability risk.
Right.
The two colleagues here in the front row. Ma'am, you first.
Hello, Mr. Huang. I'm with Financial News. This is a question about new regulations of asset management. This new regulation is to unify different asset management product regulation, but for banks compared to those other financial institutions, their product would have different rules. For example, the banks would have more investment target, but the financial organizations can have lower interest rate. They have certain conflict. What is your view in there, and will these two products in the future will unify in terms of regulation?
So that's unification between different products. Sir.
Hi, I'm from Nikkei. Baoshan Bank was taken over by PBOC in May. What do you think about the impact of the takeover on money market? Thank you.
Okay, and we've got, we need to be on time here, so 1 minute per question. So
Okay.
that's okay.
Well, the Baoshan Bank, I think it's a serious issue, but the PBOC and the CBIC are joining force trying to deal with the problem. I actually think this is a positive step because risks need to be released. If there is a risk, they need to play out. That's the only way of maintaining overall financial stability. My personal guess is the problem is probably a little bit more broad than just one single bank. But again, I don't think that is going to destabilize the whole banking sector. So I think the overall financial stability is okay. The second to last question about the standards for the asset management products are run by different sectors and so on. My prediction is that they will converge. And I think there are even some discussions that they eventually will converge, and they may happen relatively sooner. In terms of the financial, social stability, I do think social stability is a serious concern. But at the end of the day, I think two issues we need to keep in mind. Number one, if we maintain all these guarantee and allow no default, no bankruptcy, that looks like it's a social and a financial stability, but the problem could become much, much bigger. And my worry is the government will at one point won't be able to guarantee everything. And in terms of a systemic risk, I think it's much better to have some of the isolated cases of the risks to play out, and just like what happened to Baoshan Bank. So I think that is actually a better way of achieving the overall financial stability. Maybe two things we needed to do. Number one is in terms of the specific financial problems, we can still find ways of dealing with these issues. And the Baoshan Bank is a good example. We might see bigger problems there, but there could be some systemic mechanisms utilized to stabilize the situation. And one mechanism we already have is the deposit insurance system, which we set up in 2015 and we never used. I hope this will be the first time we actually utilize this mechanism. The second thing, as you said, about the social stability, I agree that's a bigger concern. But there are many ways of maintaining social stability. For instance, providing better social protection, improving the social welfare system. That's probably better than maintaining problematic enterprises or financial institutions because the consequences would be much, much more serious. Finally, interest rate liberalization. I do think if we liberalize the interest rate in the near term, we might actually see the cost of funding for SMEs rising. But guess what? My own sense is if we're really interested in lowering the cost of funding for SMEs, there are only generally 3 ways of doing it. Number 1 is using monetary policy. Number 2 is do better risk assessment, risk pricing. And number 3, if the government thinks the market rate is too high for some SMEs, which are very important for social political reasons, then the government should subsidize it, not asking the banks to lower the lending rate. In fact, I think the way to improve and increase the funding for SMEs, the first step is actually to raise the lending rate, not to lower the lending rate. If you mandatorily push the lending rate down to 4%, most banks won't be able to do it because the risk is just much, much higher than the benchmark rate.
Great. I'm going to use up my last minute very carefully. I want to ask you 2 questions, if I may. First of all, what is the most significant change you expect to impact the shadow banking market in the next 24 months, say 12 to 24 months? And secondly, what is your outlook for the private sector? Currently, it's 60% of GDP, 90% of job creation. How is that going to change?
Well, I think in terms of the shadow banking, as I said, is still in the middle of the transformation. My own sense is that the regulation will improve over time, and these shadow banking transactions will become more formal financial activities. But a critical part of it, as I said, is much more market-oriented reforms, including interest rate liberalization. So, in fact, in the end, you will find a lot of shadow banking transactions will be integrated or aligned with the formal financial sector, either the banks or the trust companies or the formal capital markets. They're actually on the same streamline and under the same regulation. That's my first point. The second, in terms of the private sector, I don't think there's any doubt that the private sector will become more important. And one critical reason why we're seeing today is the Chinese economy already shifted from resource-driven, import-driven economy to innovation-driven economy. When the reform started, GDP per capita in China was $200. At the end of last year, it was already $10,000. So we need innovation to drive Chinese growth. But guess what? Of the Chinese corporates, the private enterprises contribute 70% of the patents, corporate level patents. So we have to rely on these private enterprises to drive the Chinese growth. Otherwise, we're stuck.
Professor Huang, that's been a fascinating 30 minutes. I hope I've been illuminated hugely, and I hope you have too. Thank you so much. We do have to close this session because we have an opening plenary to get to. Thank you so much.
Thank you.
Thank you for joining us here. Thank you for watching us live online.
Thank you.